What's going on, everybody, and welcome back to another Next Big Thing HQ This Week in Crowdfunding. This week, another kind of slow week. I feel like I've kind of been saying that for the last couple weeks, but not a lot of huge stories. But I did want to start this week by recalling something we talked about last week, which is the slowdown of VC funding and how it's affected crowdfunding. If you click the link down in the description, it'll bring you to an article from PitchBook, none other than PitchBook, and they talk about how VC funding has slowed down and crowdfunding has not. They go in there and give a lot of detail about how crowdfunding could, the benefits of crowdfunding and how it's grown in this time when VC funding has slowed down. A lot of the stuff we've been talking about the last couple of weeks, not even just last week. So if you want to read through it and realize that, or think that, oh, these guys aren't as crazy as maybe they seem, PitchBook talks a lot about it. So Connor, any thoughts on that growing trend?
Well, my thought is that Reg CF is getting better and better. The companies that are applying for Reg CF are getting better and better, and they're sending out more information. So the investor now trusts Reg CF more. And I guess startups realized that if they have a D2C startup, one of the best ways for them to grow is going the Reg CF route, because they can turn consumers into investors and investors into consumers. So it's a win-win from the startup perspective. From the investor perspective, it's a win-win because you get to use the product as well as invest in the company. And from the consumer perspective, it's a win-win because the product that you love, that you use all the time, is getting more and more popular and it's getting more and more traction. And now you have the opportunity to invest in that company if you want to. So overall, I think it's a great system. I think it's a great idea. I think there's been great execution on the platform aspect, on the Reg CF aspect, on startups and how they're campaigning these rounds. And I think it's going to continue to grow and it's going to continue to get bigger. And that's kind of the bet that me and you both made with this podcast when we first started. We saw this and we knew within the next 2 years, this industry is going to be massive. And it is growing at a very fast rate. And there's a reason why. It's because it's a very good idea and they're starting to figure out how to actually execute it and the little nuances in order to execute it at the highest level. And I think this is just the beginning.
I agree. Just a couple tidbits for people that maybe don't have the time to read the article. It starts with a case study of the SIL that we talked about last week, talking about how they are using crowdfunding now, raising a down round, and how down rounds have become a little bit more popular. Not popular. They've been happening more often. And
is it like out of necessity?
Yeah, out of
with
necessity.
Like 21.
Almost. Funding is dried up and they still need to raise capital, but they can't raise it at the same valuation. Now, crowdfunding has created a great avenue to raise a down round. And another thing that we've been saying that the article mentions is how it creates customer-oriented, advocates for your business. And customers are good, but advocates are better. So it's exciting to be a part of this Reg CF growth and continue to follow how the industry has been getting bigger and bigger. So just wanted to start with that short tidbit. And it's nice to see that PitchBook is covering that. Probably one of the biggest companies in the startup ecosystem as it relates to data and working with venture capital firms and angels alike. So nice to see that they're covering that. Connor, you want to tell us a little bit about the Birkenstock IPO? That was kind of the biggest thing in, not just startups, but the finance world this week. Wouldn't really call Birkenstock a startup since it's been around for 250 years, but maybe talk about that. And I know you wanted to talk about the Sparc idea from Bill Ackman and how it might impact IPOs going forward.
Yeah, so I'll kind of connect one to the other. I'll start with Birkenstock going public. Obviously, it didn't do great once it IPO'd. It's IPO'd at 46. I guess last night, it closed at 37. So it IPO'd more or less with a $10 billion market cap. Now it's at a $7.5 billion market cap. However, Brendan and I talked earlier, and I think as entrepreneurs and as lovers with startups and understanding the hustle and grind, we need to applaud the Birkenstock company because this is a true story about resilience. They were founded 1774. So it's been 250 years since they were founded before they IPO'd, and they sell sandals. They're not selling some
Yeah.
insane product. They somehow figured out how to take a sandal company public, which just blows my mind. I'm still trying to figure out how. Now we'll get into the numbers. $1.4 billion in rev selling sandals. Pretty impressive. Their EBITDA was $378 million. And I guess this kind of goes to, now I'll get into, I guess, some of the multiples and show you why the stock price probably went down and why I think it's going to end up hovering around the 30, 32, maybe $28 per share range. Right now, Birkenstock is at a 40 PE ratio. And if you use Nike as comparable, Nike's at a 30. So obviously, Birkenstock's a little high, probably going to fall closer to Nike's. Nike has much more upside, just I think based on the business model. Nike's premium shoe company, as well as one of the leading retail clothes apparel company, right? So Nike probably has some of the highest brand awareness out of any brand. And 100%. Then if you look at price over EBITDA, Nike's trading at a 21x, while Birkin is trading at a 27x. So I think Birkin's share is going to fall a little bit, but as we were talking about earlier, shout out to the company. Shout out for going public. That's so impressive, and truly figured out how to get product market fit selling sandals. I didn't know that was possible. I still don't know if that's possible, but somehow they did it. Brandon, what were you saying the CEO said on CNBC?
Oh, yeah. This was like one of my favorite lines I've ever heard from a CEO. This was just so out of the blue. He was talking to, I guess, Squawk on the Street, like Jim Cramer and all them. And he was like, yeah, wearing a Birkenstock sandal is the second best thing to walk in barefoot. And I was like, oh my God, like what an awesome way to portray your product. And it goes to like what he said, like it could sound ridiculous, but like if you know any person that owns these sandals, they like swear by them. They wear them at like the weirdest times.
It's
one.
Like a cult. It's honestly like a cult.
It is. Are they comfortable? Like, do you know? I don't think you own any.
I've never worn a pair, but if you look at anyone wearing sandals, like, bet you $100 it's gonna be Birkenstocks every single time. I've never seen someone wear sandals that aren't Birkenstocks, right? It's
exactly. Like you're either wearing flip flops, like rainbow flip flops or reef flip flops, but if you're wearing like something like sandals, exactly, like it's Birkenstock, and they have to be a good product, right? And that I also read in the Wall Street Journal, the article was literally titled "How These Ugly Sandals Created an IPO." Like it's a funny headline, yes, but like I think the messages that you can take away from that is customers are great, but advocates are better. And what Birkenstock has is not customers. They have advocates.
And you don't need an amazing idea. It could be something as simple as selling sandals, and you just figure out how to be the best sandal seller. And then you figure out how to grind it for 250 years, and then boom, you go public just like that.
Yeah. Like literally, I was looking at one of the like display shelves, I guess they had. I don't know. It was on CNBC. I saw a clip of it. And it's just like the same sandal in like different colors. Like it's not like they're reinventing the wheel. It's just like, like this product is awesome and people love it. So like that, I mean, you love to hear stories like that, right? Like family business, right? 250 years. So makes you feel good to hear a story like that.
Yes. And connecting that to the Sparc. All right. So Sparc is Bill Ackman's take on the SPAC. He created a new vehicle. It just got green lighted by, I want to say, the SEC. And Bill Ackman, also known as Bill Spackman, kidding, bad joke. Heard that when I was listening to This Week in Startup. I thought that was good. And he's creating a Sparc. Now, this is the key difference between a Sparc and a SPAC. SPAC collects money up front from investors, and then they get into deals. With the Sparc, Bill Ackman will figure out deals, disclose them with the companies at a set price, and then after it's disclosed before a press release comes out, which is very important, before the press release comes out, he'll then approach investors and say, hey, do you want to invest X amount of money in this Sparc? They say yes or no, and then once they raise the minimum amount of money, which is $1.5 billion, then they issue the investors the rights to, I guess, to commit to the company at set price, and they get all the information and all the disclosure. So with the SPACs, there was very little disclosure, and it was also treated as a merger. So the forecasts were very aggressive and many years ahead, instead of like a traditional, I think it's acquisition, where you really can only forecast like 2 years. You can't forecast 5 years ahead and say, this is where we're going to be. These are going to be everything on the financial statement. So this, to me, seems like a very good way for companies to guarantee how much money they want to raise. I guess the big problem with the IPO lately, IPO market, is that companies IPO and then their share price falls. So they think they're valued at this much. The market says, no, you're valued 20%, 30% less, kind of losing money from that perspective. Now with the Sparc, they can, negotiate a deal and say, we want our price to be like this. Bill Ackman says, okay, let me go raise money. He raises money. He says, okay, we can guarantee you $4 billion, and then you can try and raise other $6 billion through an IPO window. Now, how it hurts non-accredited investors is that instead of $10 billion being accessible to non-accredited investors on the stock market, now it's only $6 billion because $4 billion is already allocated. Like the $10 billion, there's a $10 billion float that's going to float out to the market. They take the $4 billion out of the $10 billion and allocate it to accredited investors, the institutions, the family offices that Bill Ackman approaches through the Sparc. So that's my only concern for non-accredited investors, is that the supply is going to be significantly less. And I don't know how that affects the retail share price. I think that will increase the retail share price, which means non-accredited investors might be getting, not the best deal.
Right.
I don't know how else to put it.
No, I think with something like this, like, you look on the surface, right, and it sounds like a perfectly timed instrument for like what's been going on in the fundraising world. As in, I'm a company, I want to raise an IPO, I want to ensure that I'm going to raise a certain amount of money, to keep my business going, right? I don't want it to be a mystery, and I don't want to end up, at a point where I don't raise the amount of money that I actually need. But then, I look deeper, and this just might be not understanding the vehicle. Like, I have a couple questions of, okay, so Bill Ackman goes out there, agrees at a price, and then goes out to these family offices. Like, what if he doesn't there's like no demand, like nobody comes out, nobody wants to buy these shares? Do those shares now just get pushed over to the IPO float, or does the deal fall apart? Right. I don't know. I admit that could be like a very simple answer. And then your question of do those shares that that lower supply that's going to be brought out to the IPO, does that affect retail investors negatively? Does it affect retail investors positively, because now this company knows that they're going to raise a certain amount of money, and it's the shares that are out there are, I don't know, maybe there isn't a positive spin I can put on it. I can't think of it off the top of my head, but yeah, I have a lot of questions, but it also seems like a really good idea.
Yeah, I think the Sparc is, what I heard is, it's more or less a venture round, but a venture round for the IPO process, so that these companies can guarantee set amount of money when they go public.
Round.
It's like I don't know if it's a bridge round because they're kind of making their valuation, right? They're saying this is our valuation, and accredited investors not accredited investors, but these institutions, family offices, they can invest at that valuation, like a certain percentage. So the valuation's increasing, right?
Right.
Before they go public. and then that way they can lock it in without kind of being 100% at the whim of whatever the market thinks they should be valued at. And if they can't get that money guaranteed, then they'll probably just go public anyways. This is just another opportunity for them to try and guarantee how much money they can lock in to figure out how to continue to grow, how to continue to hit next year's numbers, how to continue to hit the year after that's numbers, and I think continue to innovate and try and get better and bigger.
So here's a question for you, and I don't have an answer to it. You might not either. So, hypothetical situation. Think of a company like, let's say, Stripe, right?
Yeah.
And Stripe wants to go public, but the Sparc round that they're going to go through with Bill Ackman, it has a significantly lower valuation than maybe their Series B investors got, right?
Right.
How do you think a Series B investor is going to look at that and say, okay, like they're raising a down round at a significantly lower valuation, ensuring that they have a lower valuation rather than going public and letting the market determine that valuation? Do you think this is going to turn off Series A, B, and C investors that may have had a ridiculously high valuation, and now they're ensuring that that valuation is lower rather than just floating those shares out to an IPO and saying, you know, I'm going to go public at a slightly lower valuation, but it's possible that the market thinks our valuation was, correct. I don't know. That might be a bad example because Stripe, a lot of the companies like that have ridiculously high valuations and they know they're going for a down round. But what do you think like investors are going to think in that way?
So I don't think it's going to be like Series B, C, D rounds impacted. I think it's going to be what we saw with Instacart, the Series, I don't know, LMNOP, right? Those rounds, like the late rounds. Like the early rounds, people are still going to invest. But I don't see much with the Sparc if this becomes a very popular vehicle, which it seems like it is going to become a very popular vehicle because it seems like the companies are going to obviously want to guarantee how much money they can raise up front before they IPO. Why would you want to invest in a Series L? There's no difference between investing in a Series L or investing in a Sparc. The only difference is if you don't know Bill Ackman, you're not going to be able to get into one of his deals. So that, I guess, is the key difference. And for this, you probably also have to invest significantly more. So you're not going to be able to make a $550 million investment. You're going to have to make, at minimum, probably like a 500, maybe like $100 to $200 million investment at minimum. Because the minimum Sparc is going to be, it's set at 1.5 billion. So you got to think about that. Like,
so maybe, that makes me think that maybe now on the other side, like maybe people investing in these rounds are going to like it because they know that, number one, like we talk about great companies, a lot of them accrue a lot of their value after they go public. Yep. So I think that a lot of those later investors are going to be like, geez, like we need more funding and we need to just go public. So yeah, I actually think that's a really good explanation of like, these companies need to do it. This might be a better idea than just going fully public. Let's ensure that we're going to raise a certain amount of money. It's almost like a safety IPO or a safer way to go. It is a safer way to IPO,
especially with this market, right? You don't know what's going to happen.
Yeah.
The market hasn't liked any IPOs, right? The market likes it at first and then doesn't like it. Like it's like eating the food and then immediately spitting it out, right? So with this, okay, let's just guarantee some money. Even if we can just guarantee 40%, that's fine. Then the other 60%, we'll let the market decide, and then we'll take it from there. But at least with this guarantee, we can know how to execute the next 2 years of our plan in order to hit the numbers we want to hit. So,
yeah. No, I'd be interested to see when the first company does it. I mean, I assume if he's gotten the green light, that it'd probably be sometime soon. I mean, there's plenty of companies that I'm sure would want to try
SpaceX, Stripe.
Stripe. You never know. It could be a company we've never heard of too. Yeah. So yeah, I think so that'll be interesting to follow. And I think that does it for us this week, right? We got anything else?
Appreciate y'all. That's it. We got 2 massive interviews coming up. Tune in for them. Other than that, we appreciate y'all. We appreciate the support, listening to us, following us. Thank you. And we'll be back next week.
Yes, we'll be back next Friday with This Week in Crowdfunding, and watch out for the DoxyChain interview and the next Investor Series interview. Going to be two fantastic interviews. So I'm excited to put those out and, watch, listen, subscribe, like, do whatever you can. We appreciate all your support. So
Yep.
with that being
See
said,
y'all.
so long, and we will see you next time.
Bye-bye.